One of the key terms that keeps coming up, especially to new investors, is a distressed property. And it's one of the key things that you look for as an investor, because you know it's one of the areas that you can maximize return. As it shows up a lot in popular advertising, like "we buy ugly houses." That ugly is indicating some level of distress, somewhat. But it doesn't necessarily mean that it is a distressed property, because distressed property in real estate has a particular meaning. Typically, distressed property is not just something that's ugly, but is in some level of financial duress or ownership problem. It can mean other things too, like there's some distress for the title, clouded title or something like that, but mostly when you're talking about investment real estate, the key levels of distress, there's really three. Now, the distressed property is going to be any property that has an ownership issue that is other than private conventional ownership. What private ownership is when you've got somebody who owns a property, whether it's under a mortgage that is not underwater or it's owned free and clear, that is privately owned property, and it is owned independent of anyone else. There's no other party to be involved during its sale or trade or anything like that. So that's a private sale, and that's the vanilla golden nugget of regular real estate. That's what you're looking at, is the private sale. From private sale, the distressed levels kind of begin. If it's not a private sale, then what is it? And there could be a couple different levels to distress. I mentally break them down into really three key categories. The first would be a short sale. Now, a short sale is a property that's still privately owned. The people who bought the property still own it. However, it's mortgaged for more than it's worth. So in order for them to sell it, they would have to do what's called a short sale. And what that basically means is that they're going to have to convince the bank to take less than they owe on the property to let them sell it or relinquish it. I'd say that's the first level of distressing, because one of the key issues that shows up with a distressed property is whether or not it's vacant, how long it's been vacant, if there was any damage rendered to it before it became vacant or after it became vacant. And the longer a property is vacant or not under management of any type, the higher the risk of the property being damaged or having some kind of an issue. So that's the key risk versus reward element of real estate investing, I would say, when it comes to distress. So with a short sale, it's the lowest level of risk, because the homeowners are most likely still in the property. They're living in the house, usually. They may be behind on the mortgage, they may not. Either way, more often than not, there are people in the house, and they're trying to get rid of it. They're trying to get out from underneath it. They could have been one of the subprime loans that were trapped in an adjustable rate. It could be a million reasons. Really, the reason why they're short selling property isn't the concern. The only thing that matters is that they are. And what it means is that they can accept your offer. If you give them an offer, they can accept it all day long, and that's great. But the offer is subject to third-party approval, and in most cases, the third party that's approving it is going to be the bank or the lender, but typically it's the bank, the mortgage company, the person who holds the note on the property. So if you were to say, as an investor, find a piece of land or a house that you want to buy, and the list price on it is $80,000, and you put in an offer of $60,000, the people who own the house might say, hey, yeah, that's great, I'll take it, I just want out. But then that offer would then have to be handed over to the bank or the person who holds the note, the person who has to eat that lost investment, that loaned amount, and they have to approve it. And they have their own internal processes for that. Depending on the institution, there's a lot of different ways that they could handle it. But for the most part, they will get what's called a BPO done on the property, which is a broker price opinion. And that gives them, it's basically their informal appraisal. It's not supremely informal, but it doesn't function the same as an appraisal for the property. And that, based on the decision of that, whatever the results of that are, will basically give the lender their idea of whether or not they're going to accept the offer. Short sales can take a very long time. Now they're getting much faster because banks are getting more used to doing them. In the past, they were a relatively unknown financial vehicle. Banks didn't really like doing them, and they didn't do a lot of them. When the foreclosure boom hit really big, and the banks kind of had no choice at one point to just be like, all right, well, we're losing properties left and right here. We're getting defaults all over the place. They had to come to grips with them, and then since then they've become more common. At the height, I mean, I had seen short sales that had taken a year and a half before you get a yes or a no, and at the end of that year and a half of waiting from the day the offer was placed, the bank can still say no. The bank also, I mean, they go through different periods of having crazy rules about what they will and won't accept, things they'll want. They'll typically ask for different concessions from every player involved. I mean, if you've got, items that, you got a Harley, I mean, they might want you to sell your Harley before they're willing to give you the short sale. There's a million different variables, but honestly, none of that as the investor really matters to you too much. The biggest key thing is just to understand the players and what's going on, what you're asking, and what your timelines are. Right now, I'm typically seeing short sales taking anywhere from 90 to 120 days. That's the average. I mean, you can't really say there's an average because if there's multiple liens on the property from multiple mortgages, it could take considerably longer because all those people have to be appeased in the process of the short sale. But just, long story short, I tell people at least 90 days figure it's going to take before you get a short sale approved. For investors, that's a good thing because it allows us, because we're not going to move into the property, we don't necessarily care as much. We're not under the same level of motivation as a homeowner is, where they want to get into the house and live in it, and they have other life concerns that have to be dealt with. We don't have those. So short sales are a good opportunity for us to get properties that are under market value. But just again, be aware, different banks are different entities entirely. They have different processes. Some are easier to work with than others. Some are handled by are facilitated by attorneys who are used to short sales. Some are handled by just real estate agents. Some real estate agents are trained in how to do short sales. Others have no clue. It's kind of a crapshoot. So there are a lot of variables. So there's a relative level of risk as far as getting the transaction approved. However, nothing is really, if you don't have any timeline to consider, you don't have to have the property by a certain date as an investor, then, I mean, it's a really good option. You definitely have some possibilities there. The next level down from that, and I say down because there's a higher likelihood that there's been problem rendered in the property, and that is a bank-owned or an REO property. This is a property that has, whether or not they tried to short sell it prior to that, the homeowner went into foreclosure, the bank repossessed the house with a sheriff's sale, they went through the redemption period, which varies from state to state. In Michigan, it's 6 months for most property. So, I mean, the property's been most likely vacant for a while. Not only it being vacant, there's a lot of times when people are forced to leave houses that they feel that they've been slighted by the finance company or the lender or whatever. There could be damage that the homeowner's done to the property. We've seen that. We've seen a lot of torn out copper. A lot of appliances are gone. I mean, there's going to be another level of damage to the property most likely in a bank-owned situation than would be if it was a short sale, people are still occupying it, or if it was a private-owned sale. So it's not to say that all of them are. I mean, there's definitely a lot of people who've gotten really good deals on bank-owned properties. Another thing that banks do is they can sell properties in bulk. So if you've got a smaller bank like a credit union, you can roll and buy all of their foreclosures. You got 10 on the market, or you're not even on the market. You got 10 properties that have been taken back. You want to sell them all, and you can get deals that way. A lot of people are doing this, and this is even a thing that institutional investors and hedge funds are rolling into. Now, as we see the foreclosure tide come back a little bit, it's not as big of a thing as it once was, but it's still there. It's definitely still always going to be around. There's always going to be some level of foreclosure activity happening, and wherever those things happen, I mean, there's always an opportunity for investors. So that's basically the mid-tier that I see of distressed property. When you get under that, and I say under that because, again, the timeline is getting longer with each of these. The timeline of them being vacant and them being vulnerable as properties gets longer and longer as we go down the list, and that's why I say, underneath. And that would be a government-owned or a HUD property. More often than not, what a government-owned or a HUD property is that HUD is the U.S. Department of Housing and Urban Development, and typically HUD properties are properties that were purchased initially for their owner with a federally subsidized loan like an FHA or an FHA 203K or a VA loan or something like that. And what happens in these loans is that when the homeowner defaults on the FHA loan, initially took the loan out with a bank. The bank insured, or the government insured that loan for the bank. So basically they said, all right, you give this guy this loan for this reduced amount of down payment and different terms, and if something goes wrong with the loan, we will back you up a certain amount of the loan. So it mitigates a lot of the risk for the lender, and it gives them more of a reason to lend to people that normally they wouldn't have loaned to, or that people that didn't have the money. In an FHA loan, it's 3.5% down versus a conventional loan, which is typically 20% down. The VA is even better. It's a loan program that it's riskier, and banks wouldn't really do it if they weren't getting this backing from the government. Well, when everything fell apart a handful of years ago, a lot of these loans were backed by Fannie Mae and Freddie Mac. And because of that, when a ton of people defaulted and all those foreclosures hit the market, first the bank takes it back in a regular bank-owned process, and they go through the sheriff's sale. They do the whole deal. They go through redemption. They get the property back. And then what happens is they will turn around to the government and say, well, we got this property. We don't want it. Here you go. They hand the property back to the government. The government gives them back their whatever the insured amount for the loan was, and the bank goes back on its way. The government gets keys to a house. Done. So the property is now owned by the government. And much like the bank, the government really doesn't want to own this property. It would prefer people to own it and pay taxes on it. The bank, the same reason that they sell their property, a lot of people think that the bank is foreclosing on me because it wants to steal my house. The bank does not want your house. The bank is not in the business of home ownership or house selling. It's not a property management company. It's a bank. It wants to get the money off your loan. It sells loans. That's what banks do. In the same way that the government does not want your property. It does not want to hold on to another liability as far as it's concerned, because it has to pay to keep the property maintained, which they do. They do have minimal maintenance on the properties. Properties that are HUD-owned have been probably empty for a while. They also are at a higher risk for vandalism or theft because typically HUD properties, at least in Michigan, I don't know about every state, but in Michigan, there's only 7 HUD keys, and most agents have their own set of HUD keys, and those 7 keys open every single HUD-owned property in the state. I know a lot of builders, property management people, they have HUD keys. So, realistically, anybody can get into the house really whenever they want. You don't have to schedule showings in the same way. You don't have to, there's no running tally. They have a sheet of paper that you're supposed to sign in when you get to the property, but realistically, if you don't feel like signing the paper, you won't. So there is the possibility of anybody who wants to going into a HUD house and taking out whatever they feel like. So with that risk comes a really good opportunity for investors. And I will cover actually the process of investing in HUD properties in a separate video, but in this video I just wanted to kind of talk about what they are. So that's the third level of distress. At least the owned distress. There's obviously other levels of private owned property can be vacant, and obviously that's its own kind of distressing. But when I say distressed, I'm talking about in terms of the ownership being abnormal to private ownership. So that's basically what I see as far as being the field of properties that are out there to play with. and each level down, you incur a higher level of risk potentially because there is a longer period that the property has been untouched. More people have been through it, more hands have been on it, and not many of those hands were as caring as a homeowner would be. So with that higher level of risk that comes from the property, you have the potential for a higher return on the money. You might get a HUD house that needs, all new electromechanicals, but if it only costs you $3,000 to put in, all new plumbing and replace, the core of a bathroom and another $1,000 to redo the floors and paint it, and it turns around and sells for considerably higher than what you can purchase it for, I mean, that becomes a net return on investment. People don't want these houses typically. These are investors. And again, in the other HUD video, I'll talk about, the differences between who's buying what and who can bid on different things, because it is somewhat of a bid process with HUD. But for the most part, the higher the risk, the better the return, just like everything else. And that is what I had to say about distressed property and their types.